Hi, I'm Max Keiser. This is the Keiser Report. You know, we've got so much to cover, still a little time, but we're all going to get it done. We will, with the help of the gorgeous, the genius, the one and only Stacy.
Yes, you know, here on Keiser Report, Max Keiser over here, actually, he has his Twitter account back. Twitter.com/Max Keiser. It's taken him 9 months, but the people over at swanbitcoin.com helped us to resecure it. So we have Max Keiser's Twitter handle back. I do want to say that there have been many people out there pretending to be Max Keiser and sending DMs to people. If Max Keiser DMs you, it's not Max Keiser. It's a imposter. But there are people imitating Max as well in the mainstream financial press, and that is CNBC looking at the data out this week about the Cantillon effect, essentially. What we've been talking about here on Keiser Report for quite a long time, but a lot of data is out about the wealth and income gap and the inequality that has happened since this latest financial crisis, the pandemic-induced crisis. And they actually kind of suggest something akin to interest rate apartheid as part of it. A tale of two recessions. Some Americans thrive as others suffer. The recession's financial pain is concentrated among certain groups like minorities, lower earners, and women. Others, especially white men, high earners, and those with higher levels of education, have been insulated. The disparity even extends to those lucky enough to still have jobs, which is unique during downturns, experts say.
Oh, yeah, absolutely.
I'll get into the interest rate apartheid later in the article.
Oh, yeah. Well, I mean, so the setup is quite clear. There's the gap between the have-yachts and the have-nots, you know, is getting wider. And it's not hard to figure out why. And it's creating social unrest. And the central banks are at the root of it, and tell us more.
Yeah, so we're going to look at some of the data, Max, and you could see in this that every time there's a financial crisis, the central bank comes to the rescue, and the central bank comes to the rescue since 1971 because they can print money. They can print their own currency, unlike prior to 1971 that their currency was backed by gold, our currency, at least on an international trade account unit. So here we have a situation where they're printing money, but it's going to certain people, and you can see that in the data. And when you look at the unrest out in the streets, you know, yes, it's caused by this situation, the murder of George Floyd, but there's something deeper and systemic that is also the anger is due to the inflation, due to the injustice of the money printing. So with this latest crisis, we've seen an overwhelming number of minorities and women lose their jobs compared to white educated men who are, you know, think of the tech bros. They're working from home. They have it really good right now. They're getting paid, you know, many of them are receiving the $1,200 stimulus check. The data from the Federal Reserve shows that they mostly saved it because anybody with over $3,000 in cash already in savings, the Federal Reserve data showed that they didn't spend the $1,200. Those with $500 or less spent the entirety of it. So, you know, in terms of this pushing on a string where the wealth keeps on aggregating to the top no matter what the Fed does, no matter what the government does. And what they found is that even Jay Powell, in testimony to Congress last week, he said the burden of the downturn has not fallen equally on all Americans. Instead, those least able to withstand the downturn have been affected most. If not contained and reversed, the downturn could further widen gaps in economic well-being that the long expansion had made some progress in closing. This is the same guy that just days before his testimony said that the Fed doesn't cause wealth and income gaps. And yet all the data released in the past week demonstrate that, in fact, they've caused a lot of this crisis because of the property assets and the stock exchange going higher and interest rate apartheid.
Yeah, well, absolutely. And so, look, the American economy is an economy built on consumption, right? 60 to 70% of GDP is consumption. It's not production. It's not like Germany or China where people produce stuff. They consume stuff. That's the American economy, consumption. And that includes the consumption of credit to buy all that stuff. And that means that savings is looked down on. You know, memes like the paradox of thrift or the savings glut. You know, this is all about vilifying savings, that nobody should have savings. It's better for the economy to just spend it all. And as a matter of fact, go into debt. Well, here's the funny thing about debt in this economy in America is that when a rich person pulls on debt credit, pulls their credit, they borrow money, it costs them zero or negative, as in the case of many people. They get paid to borrow money, as we saw with Jamie Dimon and JP Morgan. When a poor person or a disadvantaged person or typically a minority person or particularly a black person is drawing credit, they're charged 20, 25, 30, 40, 50%, 60%. Oh, a payday loan? That's 2,000%. So that's the interest rate apartheid. That is guaranteed wealth and income imbalance. It's guaranteed injustice. It's guaranteed to cause all kinds of social injustice and violence in the society because you are poisoning a huge group of your population with high interest rates and forcing them to consume, right, at the same time. So you've essentially got a mandate to end up in debtor's prison or penury or serfdom. That's a guaranteed, that's the American dream at this point.
Well, the American dream, of course, is that Horatio Alger myth that anybody could rise up and become one of the elite and one of the wealthy. And of course, part of that is owning a home. So here's the data from the Federal Reserve that everybody's talking about online, which shows how the Cantillon effect drives this inequality in terms of whoever had their home in 1971, because even the data here in the CNBC article, they don't mention 1971 and what happened then, but they actually trace it back to 1970. So in terms of this inequality. Household wealth. The median price for an existing home was $287,000 in April, up more than 7% from a year ago, according to the National Association of Realtors. These gains have disproportionately gone to the wealthy and white Americans, while 72% of white households own a house, a key source of household wealth. That's true for 42% of blacks and 47% of Hispanic households, the Urban Institute said. This gulf between white and black Americans is greater than at any other point in 5 decades, according to the report. What happened 5 decades ago, 1970? What happened after that? So from that, the wealth, the money printing has created, it doesn't create real wealth, but in an asset-based economy like our own, a financialized economy, it puts the cash, the capital, into the hands of a few.
Oh, it transfers wealth. So when you divorce the economy from a gold standard and you go on a pure fiat money standard and you have the creation, as we saw during the Reagan years, of the derivatives market and the separation of risk and reward, you have the ability for these top bankers on Wall Street to separate risk from reward, keep all the reward, and dump all the risk into the poor neighborhoods, right? So that's part of what we've seen, the financial engineering since the 80s, and has caused this incredible wealth divide. When I hear the phrase Black Lives Matter, I think what I would like to really understand is what Isaiah Jackson's talking about in Bitcoin and Black America, is that Black America will never be equal to white America. They will never have justice in white America. The only thing they can hope for is individual sovereignty, and the only way to get there is through savings in Bitcoin is the best way to get there.
But let's look at this system here, because it favored those who had the assets in 1971. We just covered this in a recent episode. Here, their data is showing that even to this day, it continues. So we could take down every single monument that exists in the United States. We could, create new holidays. We could have corporate new logos saying that we support minorities, black people, women, LGBTQ. We could do all this, but the fact is, this system, no matter what we do, no matter how we try to rescue the economy, save the people, the pandemic is happening, trillions of dollars must be printed. The way the system works, basically the Fed can only give it to mostly white bankers on Wall Street. They get it first for 0%. Everybody else gets it. If you think of a river that starts at the top of the Himalayas, it's fresh, clean, lovely water at the top. By the time it gets down into, somewhere in India in a crowded city, it's polluted, it's dirty, it's horrible, right? Well, that's what happens to the money system here. But it happens generationally, too. So another bit of data that came out this week in terms of the generational thing is quite remarkable in terms of comparing the boomers to the next generation, Generation X, to millennials. So the millennials, the oldest millennials are 39 this year. So they look at the data of how much wealth as a percentage of overall wealth in the economy millennials own today at 39 years old. Then they compare it to Generation X when they were 39 and boomers when they were 39. Boomers owned 21% of U.S. national wealth when they were 39. Generation X owned 7% when they were 39. And millennials, when they're 39 today, they own 3%. So again, this is that whole, the Cantillon effect, the interest rate apartheid, all of that stuff, because a lot of the interest rate apartheid comes from the fact that, the credit rating. So minorities, women tend to have lower credit ratings than white educated men, partly because they had the assets and the wealth in the first place when we went on to this fiat system to build up the credit and to make sure they always had cash backing whatever loans they were taking.
Well, it's funny because I'm a white male boomer whose career is on Wall Street.
Yes.
Okay, I am.
I didn't want to point fingers.
I am the ground zero for this entire wealth and income gap and for this interest rate apartheid. And I'm saying, without equivocation, there's only two ways to restore justice. One would be to raise interest rates 500 basis points immediately, so you get short-term rates back to 5%, so that there's real savings and capital in the system. Or everyone who's on the wrong side of the interest rate apartheid wall needs to start saving. And they can do that in gold, Bitcoin, and Bitcoin is better. Okay, that's it. No statute, tearing down a statute does nothing. Marching in the street does nothing. Electing people to office that you think are going to help you does nothing. None of that works. I'm telling you, as a white male boomer Wall Street careerist, that I would laugh at that as my brethren would do. It does nothing.
It's, again, like Isaiah Jackson says, exit the system. You could exit the system because interest rates, that's their funny money. That's their fiat system. And whatever they want to do with their system, let them play with it and let them raise interest rates, let them, do whatever. The fact is you have to exit the system because the system is inherently unjust.
We need to exit this part of the show and take a break. And when we come back, much more coming your way. Welcome back to the Keiser Report. I'm Max Keiser. Time now to go to Michael Pento of pentoport.com. Michael, welcome back.
Great to be with you and Stacy again, Max.
Michael, last time we spoke, the Fed has been on historic printing frenzy, buying ETFs and now individual corporate bonds. Your thoughts?
My impulse is that I guess everybody should know now that the Fed is trapped, along with every other central bank on the planet. Remember we can harken back till the great tapering of assets that was supposed to bring us back to normalcy. We went from 800 billion to 4.5 trillion, down to 3.7 trillion on the Fed's balance sheet, and the wheels fell off the economy. I want to make this very clear to your audience that the Fed was back in QE and cut rates 3 times prior to anyone hearing about the phrase COVID-19 virus. So let's get that clear. So we didn't go back to normal. We didn't go back anywhere near $800 billion where it was 12 years ago. As a matter of fact, in those 12 years, we went from $800 billion to $7.2 trillion. $7.2 trillion, Max. And there is no way this balance sheet is ever shrinking again because the Fed now owns, let's just think about prior to this crisis. The Fed kind of had isolated bubbles. They engendered a housing bubble. Before that, they engendered a NASDAQ bubble. Now the Fed owns the Treasury market, the muni market, the corporate bond market, the junk bond market, the CLO market, and by proxy, the housing market and the stock market. They are never going to drain that balance sheet. They own these markets, and the moment they step away, we are going to crash faster and harder than ever before.
Right. So the Federal Reserve now owns roughly 30% of America's GDP, and they're on track to own 100% of America's GDP. How is that different than feudal lords of the Middle Ages who owned 100% of the economy and everyone living there were basically peasants, Michael?
Max, as you were very well aware, the COVID-19 virus outbreak exacerbated every trenchant gap there was and every problem that we had extant before the virus breakout. So the middle class is being eviscerated at a rapid pace. The gap between the very rich and the very poor is growing wider and wider. Wall Street is approaching all-time record highs. And yet we have 29 million people collecting unemployment insurance. I know the mainstream media will not tell you the real number. They'll tell you 20 million, but you have to add in pandemic unemployment assistance. There's 9 million people collecting PUA insurance. So you add the two together, you get 29 million people that still are unemployed in this country. If you jump off the Empire State Building and land on a trampoline, you're going to get a small bounce, but you're not going to get a bounce anywhere near where you jumped off of. So that's what you're seeing right now in the economy. You're seeing a significant bounce from zero, and then you're going to see this plateau or a reverse square root sign or a V-shaped recovery that's in desperate need of Viagra. This is a very, very long and protracted problem we have in this country. And as I said before, and I want to make this point very clear, what you're seeing on Wall Street is complete fiction. It's a fiction created by central banks and has no semblance of reality to what's going on in the underlying economy.
Right. Well, the best performing stock markets in the world are Venezuela, Zimbabwe, and in Tehran, Iran. That's because they're under a currency collapse. So can we construe from the rally on Wall Street and the S&P and NASDAQ that, in fact, America is experiencing a hyperinflationary collapse?
Well, it's certainly a stagflationary collapse. It's not hyperinflation, in my opinion, because you need a currency collapse against other fiat currencies to get hyperinflation. But certainly we're headed for stagflation. Now, it boggles my mind. Let me ask you, Max, I don't know your opinion. I mean, how much longer can we have faith in paper currencies across the globe? We're supposed to drain this Fed's balance sheet down to $800 billion. It's $7.2 trillion. It's going to be $10 trillion. It's on its way to maybe, like you said, 100% of GDP or $20 trillion. There is no going back. I mean, why do we believe that the Federal Reserve can ever support the value of the US dollar vis-a-vis hard assets? How much longer is that going to last?
I don't think it's going to last. I think, as you point out, that structurally, the situation has broken, and it's like Humpty Dumpty. You can't put it back together again. They're in a trap, as you say. Their only recourse is to keep printing and to keep buying these stocks and bonds. And they are, in effect, taking the entire economy private with a leveraged buyout from the bankers at the Federal Reserve Bank. And their attitude toward 250 or 300 million Americans that they're the new peasants. And they really have no rights anymore. And when I say the dollar is in a hyperinflationary collapse, I do mean against the only sound money in the world today, and that is, of course, is Bitcoin. So against Bitcoin, the dollar is in a hyperinflationary collapse. But to your point, I mean, my answer would be that there's not going to go back. This is the new normal, and we are back to feudalism. I call it neo-feudalism. But Jerome Powell over there at the central bank, the Fed, when he was asked point blank, are you causing inequality? And despite all the evidence that he is, he would say no. Now, is he A, pathological liar, B, a moron, C, both?
I was going to say all of the above. So, all right, I'll take C. I was watching a channel. I won't mention the channel's name or the individual, but it's a station that I was thrown off of. Okay. I used to appear there regularly, twice a week for many, many years, talking about the imminent collapse of the housing bubble. But this person said that the Fed is not manipulating the markets because they're not buying assets above the market. But I mean, I actually screamed at the television. I said, but you are the market. I mean, what would the 10-year Treasury note be? Right now it's 0.7%. What would the 10-year Treasury note be on its own, Max? You remember back in March, it was 0.3% and shot up to 1.25% when people started losing faith in the solvency of the United States. So if you have an insolvent nation and you have a 2% inflation target in that nation, what should the 10-year note Treasury be? Should it be 0.7? And we could take this to Japan as well. I mean, should the Japanese 10-year note be 0% with a quadrillion yen in debt and a 2% inflation target?
You know, you bring up an interesting point about mainstream media and how they treat this crisis. And whether it's CNBC or others that are in the mainstream who are seemingly purposefully obfuscating the reality to carry the water for a corrupt Wall Street and a corrupt central bank, when it really becomes obvious, Michael, is when a situation like Hertz develops where the company is bankrupt and they plan on selling stock in a bankrupt company. It's never been done before. And the response by CNBC, Bloomberg, Wall Street Journal is to simply throw up their arms and say, well, isn't this novel? Isn't this strange? Instead of being like a regulator that would warn people against tainted meat, or they found arsenic in the aspirin. You know, they're supposed to be on the consumer side to prevent this consumer fraud. But their attitude be like, well, if the consumer, and Hertz said, if anyone buys the stock, they're a moron. That, I paraphrase the statement in their offering document, but that's pretty much what it said. These regulators are just holding their guts and laughing like, these Robin Hood apps. One of the guys committed suicide. Isn't that hilarious? Ha, ha, ha. We're enabling kids to kill themselves here at the SEC. Isn't that funny? Ha, ha, ha. And the CNBC anchors are all laughing and slapping and carrying on like, hey, let's get all these kids to commit suicide. It's disgusting, Michael Pento. Your thoughts?
Maybe the pension plans are buying the stock because they can't make any money. If you want to buy a treasury bond or a muni bond, you're not going to make your 7% or 8% per annum requirement. You have your assets compared to your obligations are now 20% in many pension plans. 20% funding rate, Max. So maybe you, as a pension holder, are betting that Hertz, a bankrupt corporation, can issue stock and make you whole. And this lands right at the doorstep. It's right on the lap of Mr. Powell. Here's the thing that's going to happen. We have a dramatic fiscal cliff coming in the fall. Okay. We had $3.6 trillion of a pandemic relief. Then the House just passed another $3 trillion package that has yet to be approved. Now both parties want a $1 trillion infrastructure package. I mean, how much more debt are we going to add? But assuming that we have some kind of a semblance of fiscal sanity in Washington, D.C., then we're not going to have any more of these packages. And then you're going to have the PPP loans wear out, the $600 extra unemployment insurance runs out, the $1,200 sent to every man, woman, and child, and man and woman, I should say, be specific, that didn't make over $198,000 a year. So if you were married filing jointly, you got $1,200 each, plus $500 per child in your family. All that ends. That is spent and over with. That's that man jumping off the Empire State Building and hitting a trampoline. Quick bounce, and then you're faced with the fall, a gigantic fiscal cliff, and then another one in January when all of this unemployment insurance runs out. Are they going to extend it ad infinitum and have the Fed monetize all of that debt? And we're going to look like Zimbabwe? Or are they going to have some reality and have a devastating depression? Listen, watch this program. Turn off CNBS. Turn off mainstream financial media and watch the Keiser Report. I am telling you, this is the twilight zone that we are in. There is no market anymore for anything. All those assets I mentioned are all fictitious. They're all based and predicated on massive monetization from the Federal Reserve. They've already printed $3.7 trillion in the last year. And they have to keep on printing and monetize all this debt, or we're going to have a deflationary collapse, or eventually we'll have the stagflationary, hyperinflationary collapse. But one thing's for sure, we're off the reservation and things are very far from normal. Please watch the Keiser Report, not CNBS.
Yeah, right on, bro. You know, let me get your comment on something. CalPERS, the biggest public pension fund in America out there in California, you know, they are always been the joke of Wall Street. Wall Street tends to park all their risky, toxic risk into the CalPERS and other public pension funds. I know when I worked on Wall Street, whenever you had a bad trade, you just dump it in a public pension fund and they never know the difference. They've been underperforming for years. And now they say, well, to try to make up for it, we're going to go on leverage. We're going to start trading on margin.
I think the Pension Guarantee Corporation is going to have a lot of work to do in the very near future. That's guaranteed.
Yeah, fair enough. All right, Michael Pento of pentoport.com. Thanks for being on the Keiser Report.
Thanks for having me back on, Max.
And that's going to do it for this edition of the Keiser Report with me, Max Keiser, and Stacy Herbert. I want to thank our guest, Michael Pento of pentoport.com. If you want to catch us on Twitter, it's Keiser Report. Until next time, bye, y'all.